So I've got some slides I'm going to show for you all here, and a couple things, just rules of engagement here for everyone. Love to get your questions. So we have a Q&A box here in the meeting room, and I've got some of our team here monitoring that. So please, love to get your questions. I can't promise you I'll get to all of them, but if I don't get to all of them, we'll do our best just to reach out to you directly on that. So thanks again for being here. Feel free to enter any questions you have in the Q&A, and we'll get to as many of those as possible. I'm going to talk for about 30 minutes. I want to share some updates on the economy, our thoughts on the market, and then we'll take your questions as well. So see a lot of clients jumping on. Thank you so much for those of you who we work with directly. Really appreciate your confidence in what we do at Wealth Builders Investments. And so we've got a good mix of clients and friends, people we know and don't know on that. So, well, let's get started. And I really want to be respectful of everyone's time. A lot going on. We're filming this for May 11th, 2023. And again, looking backwards at what happened in April in the economy. Again, put your questions in the chat, and we'll get to as many of those as possible. Great. Well, again, I'm Chad Franzen, certified financial planner. And for those of you who don't know me, CEO and founder of Wealth Builders Investments, which is a SEC registered investment advisor. And so we work with families, business owners all over the country, and even some internationally, on helping them create a biblically based plan or approach to investing, to financial planning, to philanthropy, and just to making sense of what's going on in the economy. So I like to call it on my podcast show, bringing clarity out of chaos. And so if I do that in any small form or fashion today, I will consider it mission accomplished for that. So again, we're really glad you're here. Many of you I know, so thank you for your support and being here. Feel free to pass this along, the recording, to friends and family that you think may benefit and share our values for kingdom impact investing, and really wanting to create a financial plan that's in line with our values. All right, well, I'm going to share my screen here and get started. I want to make sure I leave enough time for questions. All right, so give me 1 second. I'm going to get my screen share going there. All right. We should be good to go. Alrighty. So again, for those of you who don't know how to find us, wealthbuilders.net is our online website. So again, if you're not familiar with that, that's a great way just to connect with us and our team at Wealth Builders Investments. We've got a team in Colorado as well as Texas and California, and so we work with folks all over the United States of America, this great land, and even have a few people, let's see, in the UK and South Africa that we work for. So real honor to be with you. So, well, let's jump in. Get my slide deck going here for everyone. And again, this is first screen I'm going to show you is just, this is my disclaimer. Again, these webinars are really for educational purposes. If you want specific advice on, hey, Chad, what do you think we should do with our personal situation? Again, we're happy to talk to you. Again, educational in nature, and my attorneys like me to show that show that to you. All right, so this is our economic and market update for May 2023. Some of these slides, if you've been with us on our past monthly economic updates, they're going to look similar, and I've just updated some of the information to give you a pulse. Well, hey, I'm a big bullet point person when it comes to emails and communication. I like just to kind of know, okay, tell me a summary of what's going on. And so these first two slides I want to share with everyone are 5 key points of what's going on in the economy right now, April 2023, as we roll into May of 2023. So we're just going to dive right in. I want to share some of the key things I'm reading. And one of the questions I get from clients and families is, well, Chad, what types of research do you read? You know, what do you and Billy follow? And so there's all sorts of things, whether it's websites and newsletters and commentators that we follow. There's a lot I don't follow. Side note. But what I try to do in this is really glean from a lot of different sources and then really pray through, okay, well, what's the most important? How do we distill what's really important to our clients, to us as a firm to communicate? So here's the first two things, key points of what's going on here in the economy. Again, we're primarily focusing on what's happening in the United States economy, but I think we all recognize this is a global economy. It's very interconnected. And so some of these things certainly parlay into what's happening in Europe and in Asia. First, point number one, United States GDP. And for those of you who don't know, GDP stands for gross domestic product. If you were going to say, Chad, hey, what determines the health of the economy, whether the economy is growing or if it's contracting or if it's neutral, it's this term GDP, right? And so for the first quarter of this year, it grew at 1.1% annual rate. Okay, so that's an important number to remember. And that was well below the consensus estimate was 1.9%. Okay, so what that means is that the wisest people in the world, bankers and analysts, were greatly optimistic in how fast the economy was growing on that. Now, I'm going to talk fast here as we move through some of this, but a recession, just to continue to educate everyone on what a recession is. A recession is when this number goes negative. Okay, so we're still positive, barely. Again, it was expected to grow 1.9% for Q1. It was lower at 1.1. So the statistical definition would be 2 consecutive quarters of this number being negative. That would constitute, academically speaking, a recession. Now, I jokingly say the government likes to move the goalpost, so to speak, on what the definition of that is. Now, one thing, and this is not on this slide, but companies. So many of you run franchises, you run small businesses, you work for ministries, even larger organizations. One of the things happening is major corporations are having negative earnings growth. So there's a lot of companies out there, brand names that you and I shop at, who for now 1 to 2 consecutive quarters, their corporate earnings are negative. And that's a real telltale sign for what we think will eventually be a full-blown recession on that. So really what that tells us is the economy is slowing down. And point number two is that inflation is staying strong, right? Okay. So what that means is that inflation is very stubborn. And we've been saying this to our clients and those of you who we visit with at workshops and webinars. Federal Reserve wants to get inflation down to 2.5%. And that is going to be a really tall order. Historically, if you look back in the 1970s and in post-World War II era, it took 2, if not 3, or over 3 years for really high levels of inflation to get under control. Now, I want to introduce a term to you. You may or may not have heard this before, but right here in the middle of my screen, I have a term called stagflation. And so stagflation, and you're like, okay, Chad, is that a real word? Or did you make it up? No, I didn't make it up. It's an academic term. And inflation, right? So this is a cousin of inflation. Stagflation is my 2 points here for key economic takeaways, is when the point number one, the economy is not growing, as it's not really growing fast. It's kind of declining or neutral, right? 1.1, 1.9, but inflation is going up. That is your definition of stagflation. That's part of our thesis for investing right now. And so, as you'll see on point number two, personal consumption expenditure, which is a inflation index that excludes food and energy for some reason. But I don't know about you, but I spend a lot of money on food and energy. That increased 4.6% year over year. It's lower than what it was, but it still has a long way to go. And I think when we look at factors affecting family spending and small business owner budgets. You still have to factor in supplies, food, and energy of that sort. So, again, two key points here. The economy is not growing as fast as everyone thinks, and inflation is not going away anytime soon. All right, well, let's keep moving through this. Again, I got 5 key economic points for you. So if you're keeping score, this is point number 3. Again, I'm trying to distill this as much as I can. And again, these are the things we think through as a team here at Wealth Builders Investments when we're creating investment strategy for our clients. So point number 3, OPEC came out announcement early to mid-April, I believe it was, that they were going to cut production by about 1 million barrels of oil. And there was also support for that from Saudi Arabia. And so a lot of analysts in the energy field believe that oil, the price of a barrel of oil, that's a commodity, could potentially go back up to $100 a barrel on that. So we need to be aware of that. I have a slide here in a minute, but I'll mention it now. The price of a barrel of oil today, this week, is around $70 to $72. So what that's saying is there's a potential for a 20 to 30% increase in the price of crude oil. Now, you don't have to be a rocket scientist to know that if that happens, then that's more or less a tax on consumers, which does affect the economy. All right, point number 4. We call them mega cap, but the really big technology names, the Googles and Facebooks and Microsofts of the world, we are now in earnings seasons here in the month of April and into the first couple weeks of May. And surprisingly, a lot of these big tech companies did have good earnings, better than expected, or not as bad as once thought. And what has happened, and true to form, herd mentality, is a lot of the big institutions, because Google had better than expected earnings, as did Microsoft. Of course, they laid off tens of thousands of people, which we covered in a previous webinar. And so what has happened is the stock market has actually ticked back up higher because there is this, I think, irrational hope, if you will, about that, well, the dust is cleared and everything's smooth sailing with the economy and the big tech names. Now, a lot of these big tech names, if you own them last year, were down 30, 40, some even 50% on that. Now, what's happened here in April and into May a little bit is big institutions, mutual fund managers, they're just piling back into some of these big tech names that were all the rage in 2019, 2020 on that. Personal opinion, I think that's a mistake. I'll share more on that later, but that's not what we're doing at Wealth Builders Investments. We're staying clear of some of these big tech, high growth, high volatile names, and quite frankly, we wouldn't invest in Facebook and Googles of the world anyway because they violate our pro values screen. All right, point number 5. Unless you were on a deserted island, and I would be jealous if you were, you probably were aware that in March and into April there was a little minor banking crisis going on in the United States and even in Europe. So we've had another bank at the end of April, First Republic Bank. This was a quieter meltdown, if you will. It wasn't as big in the news as Silicon Valley Bank and Signature Bank in March, but another bank became insolvent at the end of April. And Jamie Dimon and the boys at JP Morgan Chase swept in as the White Knight and took over that bank. So again, that was not really covered too heavily by the media, but point number 5 being the banking crisis is not over. So I'm going to speak to that here at the end, just to give you some points on what we're doing at Wealth Builders Investments. But want you to be aware of these 5 key economic points, just as you're thinking about how do I run my business? How do I invest my dollars? We need to have a long-term plan, but we also need to know, just like the sons of Issachar, we need to understand the times and the seasons And so I hope that helps. Those are our 5 key economic points. Again, we talked about the economy is slowing down, inflation is still stubborn, and then here we talked about oil, the tech stocks, and then the continued bank crisis on that. So again, I'm going to keep going through some of these slides, and then we're going to do Q&A at the end. So again, as a reminder, please feel free to drop your question in the Q&A box, and then our team will be reviewing those. Well, let me just give you a few statistics for where the markets are here in early May. Again, I don't want to get too deep in the weeds, but I want to put some numbers up here. Generally, stocks and bonds are a good thermostat, if I can use that term, for the health of the overall economy. So whether you're a small business owner or whether you're trying to save up to buy a home or an investment property, these are just good things to know about where the markets are. So S&P 500 is sitting at around 4120. The Dow's at 33,000, and VIX is at 17. Now, some of you, if you've never attended one of our webinars, most everyone I think knows what the S&P and the Dow are. Those are two of the best stock market indices to understand what's going on. Now, in relation, the S&P 500 is about 15% off of its all-time highs. So it was around 4,700 on that. Now, if you've heard me speak or my business partner, Billy Epperhart, speak at any Wealth Builder functions, he and I both feel pretty strong conviction, personally and professionally, that the S&P 500 could easily see a 20% retracement. And in fact, if you look technically at charts, which I'm not going to do today, in that sense, the S&P 500 could drop as low as 33 to 3,400, 3,300, 3,400. That's where what we call support is. So again, if we see a major geopolitical event, if we see the Fed tighten rates until the job market completely falls off a cliff, then and inflation rears back up. It's trending down, but if inflation rears back up, then that could be a problem. And it would only take one geopolitical thing, one huge news story, and the markets. I think they are overvalued right now for where we are in the economy. Now let me come back to this VIX, this VIX. So let me just educate you a little bit. This is a good number, and you can pull this number up on, any type of online quote system or on your smartphone. I have it on mine, on my iPhone. I like to watch what the VIX is doing. So the VIX is a measure of volatility. Okay, so in a general sense, when the VIX is over 20, when that is over 20, it means that there is a much higher probability for increased volatility in the next 30 to 60 days. And what we mean by volatility is that the prices in the two major capital markets, which I'm covering right now, stocks and bonds, that they have the propensity to have a lot of fluctuation up or down. Now, everyone loves upside, but not downside, right? So right now, VIX is all over the board. It was as high as 24, 25. Now it's down to 17 on that. So right now the coast is clear, but this number changes daily, and next week the VIX could be 25 on that. So you want to be aware of that, just to know kind of what's going on in the markets. Here's rates on bonds. I'm going to talk a little bit more about that. Many of you are real estate investors, so you're watching mortgage rates on that. Mortgage rates have come down a little bit, so and that helps with the seasonality of home buying nationwide. On that, you can see the 30-year traditional mortgage is around 6.5%, and the 15-year traditional is around 5.6%. Again, still wide spreads. So if you're looking for mortgage money or bank money, you want to shop around. The spreads being wide means that you will find different pricing depending upon who you talk to. So it's you definitely want to shop a little bit more. Let me throw up a few commodity prices. We do invest in gold and silver through Wealth Builders Investments. So you can see gold is near an all-time high, not too far off. It's a little over $2,000 an ounce, and silver is similarly has gone up quite a bit. It's a little north of $24 an ounce on that. And we'll throw in the good old Bitcoin, just to not leave it out, the digital gold, as it were. So it's come back up nicely. It was 18 to 20,000. Um, and so it's up. It was up around 29,000. It's retraced down to a little under 27,000. We still like blockchain digital currency. We're not actively investing in it too much right now for clients at WBI. Again, a little bit. I do view digital currencies as more of a long-term, 5-year, let's say, horizon. Again, personal opinion. Again, happy to talk to you one-on-one on that. That needs to be more of your speculative money. And then there's crude oil. I mentioned that one earlier, but $71 when I pulled this chart on that. So I'm going to come back to our outlook and what we're investing in now. So this will be helpful at the end. I'll share for those of you that are existing clients, you'll get a feel for how we're managing resources, and for those of you who are new to us, you'll get a taste for how we may do things a little differently. Well, I hang out with Billy Epperhart, who some of you know, who's my business partner. So I love a good chart. So, he's kind of rubbed off on me on that. So I've got, I think, 3 charts I want to cover. Again, this one I've shown before. This is called the Buffett indicator, and named after Warren Buffett, the Oracle of Omaha, right? And how cool to have a nickname like that. So when he, very successful investor, been around forever and a day, and his company Berkshire Hathaway invest in a lot of different companies. I'm going to tell you, so stay with me. I'm going to tell you in a couple minutes what 2 companies are that he has been buying a lot of. And one of them is actually one that we invest in. So, but anyway, so this Buffett indicator, again, we're just talking about, are the markets overvalued, fairly valued, or undervalued, right? Okay. So you don't have to have a finance degree to understand if we plot data on a chart to see. Now, what you'll see here, I think you can see my cursor. The top end of this, where it is the red, the higher this blue line goes, the more overvalued the stock market is. Okay. And the lower this blue line goes, the more fairly valued, or let me say undervalued, the stock market becomes. So if you are a buy low, sell high person, whether you're buying real estate or gold or a business or stocks, you would prefer to be paying prices when they are lower on this scale, either in the light green or the dark green on that. Now the gray line there is historically the average, historical average going back. This goes back, I think, 75 years on this chart. So what we see, you can see the box here as of May 5th, 2023, that the market value compared to the economy is still it's called 165% ratio, which just means 100% would be this gray line. So still overvalued. Now, much like real estate, you can always find investments that are a good price. That's true in stocks, bonds. It's certainly true in real estate because it's a regionalized market. And even if you're wanting to invest in a private company on that, we think what will happen, I'm going to call this financial gravity, is that the impact of a coming recession, the impact of further banking crisis is going to lead to commodity prices going higher, but it's also going to lead to stock prices getting back down to a better entry point if we're long-term buyers. All right, well, here we go. Warren Buffett, here 2 companies that he has been heavily investing in of late are Chevron and Occidental, both of which are large energy companies, headquartered here in the United States. And energy actually made up about 14% of Berkshire Hathaway's portfolio at the end of 2022. And then that was actually as high as it had been in over 20 years on that. So Occidental is a company that is on our Pro Values list. So they pass our test from a filter as far as biblically responsible. Chevron does not, although they're not terrible, but we would lean more towards Occidental and a few other energy names on that. So again, Buffett's betting big on oil. Energy did really well for us last year in some of our companies that we invest in, both publicly and privately. So for those of you that are clients, you're probably aware of that if you're keeping score at home. So we think this is going to be a continued trend. We think energy is still going to do well, and of course, if OPEC drives oil prices higher, well, that's not good for me filling up my F-150 at the pump, but it's really good for my portfolio because those public and private companies that I'm investing in for myself and families at WBI and Mr. Buffett here, they're going to go up in value. So anyway, that might be worth the whole time. You got a couple of names there that some of the most prolific investors of all time are getting pretty heavy in right now. So I think the trend in energy will continue to be a positive one. So if you're wondering, okay, what types of things does Chad believe are going to continue to do well? I think energy is certainly on that list. All right, I think I've got two more charts, and then I'm going to give you all some bullet points. I'll get back to my PowerPoint and away from the charts. So appreciate everybody being here. Again, feel free to put questions in the chat, Q&A. I know we're going to be watching that on there. This is another chart. Again, this comes from currentmarketvaluation.com, so you can go look these up yourselves. I just showed you a chart on stocks, right, and how I think my thesis is stocks are overpriced. Now I'm going to show you a chart on the bond market and why I think that a recession is imminent. So similarly on this is a correlation, or excuse me, it's a spread report between U.S. Treasury bonds, and I won't get too technical, but you can see here it's the 10-year U.S. government bond versus the 3-month government bond. So if I had one of you wants to invest some money, and we say, hey, that's great, John, we want to buy some bonds. What would happen is a 3-month government bond might pay us, and I'm going to make up numbers here, it might pay us 2%. Yeah, but if I say, John, well, we can invest it for 3 months and get about 2%, or we can go out and buy a 10-year government bond and get 4%. That's how true financial supply demand works. But when it's inverted, and I say to you, hey, John, the 3-month bond is going to pay you 4%, and the 10-year bond is only going to pay you 3%. Now it's inverted. What should happen is if you're committing your money to longer periods of time, you should get a higher rate of return, whether it's debt or equity. So what's happening here, and you see on my chart, it's color. I like this one because it's color coded. So even if you don't understand all the data points, you know that when it's redlining, it's like driving your car, and if it redlines, then and something's wrong with the gears here. All of these red lines at the top, you can see that. That is when the yield curve is inverted. It just means a short-term bond is paying me more than a long-term bond, and that should really never happen unless there's something wrong with the engine, right? Now, these little gray bars, which might be a little hard to see, but all these gray vertical bars are recessions. So this goes back to the late 60s. So you'll see recessions, 2, 4, 6, 7, 8, the last 8 recessions. Of course, the COVID recession was quick and severe, and then things took off after that. Every time for the last 10 recessions, this particular indicator has gone red. It's redlined before a recession. Okay, so look, red line, gray bar, that was COVID. You've got the mortgage crisis, 2008. This indicator redlined, and then there that is. You've got the tech bubble, early 2000. So this indicator went red right before that. You've got early 90s, George Bush administration, Gulf War, same thing. You've got a couple of incidences in the 80s. You've got the 87 market crash. Again, every time, 10 for 10, last 10 recessions. So I'm not a betting man, but if I were an investor, which I am, I would be investing with the strong likelihood that a recession is coming, regardless of what all the media sources are saying, whether that's CNN or Fox or CNBC, because the proof's in the data. Okay, and so I'm going to encourage you here at the end with some action items. I'm going to really encourage you to be cautious as we go into the summer and into the fall with your investing dollars. I'm going to skip that chart just so I make sure we leave plenty of time for Q&A. I've shown you this slide before. Again, this is the Fed meetings, Federal Reserve Bank, some of the smartest minds in the world. It's headed by Jerome Powell. It's the U.S. Federal Reserve banking system. They set monetary policy. So whether you're a retiree, stay-at-home mom, serial entrepreneur, serving in our military, whatever it is, this affects you because it affects the velocity of money. And the velocity of money determines how easy it is for you to get credit if you want a car or a student loan for college, or you want to buy a house, or you need a line of credit for your business because you're expanding. All these things go around that. So this is our scorecard for 2023. And you'll see that going back to February, March, and then this last week in May, the Fed has raised interest rates 0.25 percentage point. And I've got some podcasts on this. I don't really have time to dig super deep into it, but we talked about on one of our podcast episodes, which I'll show you how to get to that. It's called the Kingdom Finance Show. Encourage you to watch and like that. We talked about this in one of those episodes. We along with everyone else, fully expected these 0.25 point rate hikes. Now, what I put here in the middle is the juxtaposition of what everyone's thinking. So if you're more optimistic, more pessimistic, or realistic, right in the middle, will the Federal Reserve pivot? Will they pause raising interest rates on June 14th when their next meeting is? Now, the stock market believes that they are. The bond market's not really quite sure. And the economy certainly doesn't know on that. Now, I think the key point is going to be what I put here in red is jobless claims. I actually do have one more chart. I apologize. I put one in at the last minute on jobless claims. I firmly believe the Fed will continue to raise rates until the job market breaks, because that's the only way to really get inflation back down to where they want it to be. So again, keep an eye on this over the summer. This will be very interesting. Their language, they're starting to move in that direction. But again, if they pause on the interest rates, I think they're going to have to pause at some point. I think there's a probability we might get one more rate hike and then a pause. We're just going to have to wait and see as we move into June and July. Again, that all affects how severe the recession will be. Past recessions, for those of you who have been around the sun a few times, you know that this interest rate policy, they generally overdo it, right? So something breaks and then they have to lower rates on that. Okay, last chart, I promise, and then I'm going to give you some key takeaways, and then I'm going to open it up to Q&A. So thanks for being here on our monthly economic webinar. Again, if you want to learn more about what we're doing, feel free to visit us at wealthbuilders.net. And for those of you who are clients, I hope this gives you a little more insight into what our investment committee is thinking and how we're navigating the markets. Okay, last chart. I actually just found this one this morning, but I really believe that this is one of the key numbers that they're looking at. This came from tradingeconomics.com. And this is initial jobless claims, initial jobless claims in the United States. This is in thousands, so that's 264,000, right? That's 242,000. Now, I think, as well as some other really smart economists that are way smarter than me, I think the Fed is really watching this number. And then in order to get inflation under control, that they will continue to raise rates until this number gets north of 300 to 350,000. Now, that may not make much sense, but just know if you want to be watching some of these data numbers, this is one of the ones we're looking at. I think jobless claims, you can see they've been low, they've been slowly trending up, right? I think everything stays copacetic until this number gets up to 325, 350,000. And then that would be when the job market breaks, because that becomes a much higher number, which has a major trickle down effect for the economy, for consumer spending, for corporate earnings, right? You see how this is all interconnected on that. Right now, it's okay. It's starting to trend up, and that's something we need to be mindful of. All right. Well, I've made it through the heavy lifting, as it were, on the May economic update, and now I want to really just bring this down practically. I want to share a few things that we're doing at Wealth Builders Investments. For those of you that are clients, how we're managing your resources. For those of you considering working with us, to give you an idea. And either way, let's make some practical applications on that. With interest rates where they are, and with the economy where it is in what I'm going to call a pretty vulnerable place, cash management needs to be something we're all thinking about. Whether you're an individual, whether you're a business owner, um, whether you're a student, right? I mean, we need to be thinking about cash management. And one of the things we're doing at Wealth Builders Investments is, now I'm not talking about long-term investments on this point. I'm just talking about managing cash. We want to stay liquid with this particular part of the equation, and we're having a lot of success with insured CDs and money markets. And so these rates range. If you want a specific quote, feel free to reach out to us. But anywhere from 3 to 5% is pretty common in that. And so that's a good place if we don't want to be all in on stocks and bonds and real estate right now. We want more of a holding tank. I'm going to encourage you to look at some cash management opportunities. We want to encourage you to be aiming for 3 to 5% on this money. If your bank or credit union does not do that, then you need to find a different institution on that. Secret sauce on the CDs, bank CDs. You want to keep those to $250,000 per issue to make sure you stay within the FDIC and SIPC limits. I talk about this on the podcast. I don't have a ton of time to expound on that. Um, and the sweet spot right now for a CD is somewhere around 6 to 9 months. So again, in my earlier example, it doesn't behoove you to lock your money up for 2 3 years in a long-term CD, because it's not going to pay you that much. You're gonna earn more if you just put it in a 6 to 9 month CD. So I'm kind of giving you the playbook, if you're hearing it, on some of the things we're doing. And so let me talk a little bit about banks. My top 5 economic points. We mentioned that the banking crisis is not over, and so expect to hear that theme continuing. And so I want to ask you, how exposed are you? And so one of the things we do at Wealth Builders Investments is we diversify across all types of different institutions, and making sure dollars are insured and protected. And so you want to evaluate that. If you've got a lot of excess cash at a bank or credit union and it's north of 250,000, I want to encourage you to evaluate that, and even reach out to me if you want to talk through how do I make sure that's protected. And there's a couple different ways to do that. Again, just reiterating a point I've already made, but I'm kind of putting this in bullet point form here, wanting to summarize what I've covered here. We think we need to proceed with caution into the summer and into the fall with the stock market. I think the levels it's at right now are a little rich for where I want to be putting new money in. Now, we do have money in the stock market. It's mainly value focused, or what I'm going to call dividend oriented stocks. We're much lighter in international small caps and large cap tech names on that. So, if you're managing your own money, or ask your financial advisor how they're doing it. those higher growth names will fall harder if when this recession hits in the fall. There's going to be some opportunities, but we just want to proceed with caution on that. And then I think this is my last point here, gold and silver. We do own this in our investment portfolios. I know many of you, myself included, buy physical gold and silver and store it. I would, it's at near all-time highs right now. I would accumulate on weakness. So I think gold prices are going to retrace a little bit here leading into the summer. They've just had a really nice run up, and so we're glad we've been in it. Um, but if gold retraces back down into the lower 1900s, we'd probably be buying a little bit for that. So, all right. I wanted to show this slide again. These are 7 different strategies, and then we're going to jump into questions. I'm just going to put these up here for time's sake. This is a very similar slide, if not identical to one I've used before. But these are 7 of the different things we're doing at Wealth Builders Investments. And I just want to share them with you of like, hey, we talked about creating cash management. We talked about protecting your assets. Again, we're big believers in investing with pro values and investing with tax advantage strategies. So if all these things, if you're working with another financial advisor, you can, these are questions I would be talking about with your spouse, with your family, with your financial advisor. How do you create passive income? How do you implement tax advantage strategies? How do you create a good mix of what we call hard assets and paper assets? Because if the stock market goes down, well, where should I be invested? So these are all, 7 of our really key points, kind of our investing thesis for 2023. And I'm just going to keep showing them because it's helpful, just to remind us of where we are. So these are all things for those of you that are clients. These are topics we're talking with you about. These are things we're implementing in your financial plan. And for those of you who are new to us, these are some of the types of questions we would be happy to visit with you on. Or you may say, hey, Chad, I got a great financial advisor. I've been working with them forever. That's wonderful. And we just want to empower you with education and questions that you can take back and say, hey, how do we make sure we're properly diversified? We're taking advantage of all the tax benefits. We're investing with pro values. Okay, let me show you one more slide, brand new one, and then we're gonna get into some questions. We're real big on pro values investing. We really believe a kingdom framework is paramount for being good stewards of our resources, whether it's money, businesses, ideas, time. And so I may make this a regular one that we're going to talk about. So let me, I've got one more slide in here. I apologize. Again, these are just my points. Again, stagflation. Let's get right to my new favorite slide. It's a new segment called Go Woke or Go Broke. We're big believers that we need to invest based on our values, which are very much rooted in the Bible, in the teachings of Christ. And so in this month's installment of Go Woke or Go Broke, we see now we don't invest in Anheuser-Busch. They violate some of our screens anyway, but Bud Light is the latest example of companies who are going way too far into these realms, and they've lost a significant amount of market cap, significant, and it's an ongoing PR issue for them. So again, we really believe a company that is run with biblical values is going to have a higher per share earnings for their shareholders. Okay, now you don't have to be a Chick-fil-A to do this. You don't have to be Hobby Lobby. But companies that are going out to these extremes like Anheuser-Busch, they're realizing, you know what, this is not this is not going to end well on that. So again, another one of those companies that we boycott for the stances that they're taking. And just in summary, really our filters for investing are biblically responsible, pro values, and what I'm going to call social impact. Now, I talk about this in our podcast and on other webinars. I just want to mention that to you today. And so if you're not sure what that means, then I encourage you to reach out to us. And we'll be happy to educate you, show you our process, and then even you can take it back to your own financial advisor and say, hey, I want to invest using kingdom principles, implementing what the Bible says about stewardship and the value of family and pro-life. And I want to do that. There's three ways to do it: biblically responsible, pro values, and social impact. Well, awesome. Well, hey, this is great. We're going to get into some questions. I want to just, before I forget, I don't advertise this enough, but we do have a podcast called the Kingdom Finance Show. It's on Spotify, Apple, YouTube. Take a QR code picture if you want. I'm going to just leave this slide up for a few seconds, but you can snap the QR code or you can go search for it. We put out a new episode every week on the Kingdom Finance Show. And so we're really taking current events and we're just evaluating what's going on from a biblical perspective. We're also giving you some empowering knowledge on how to apply that. So that's a great way to follow us. We do these economic update webinars; are a little deeper, once a month. So sign up for that. And then the Kingdom Finance Show, we're just having a lot of fun there. So please check that out, subscribe, give us a good review, forward it to friends. But I wanted to mention that it's a great way just to follow with what we are doing. So, all right. Well, we're gonna jump into some Q&A. Again, if you want to contact us for a consultation, I think I already saw a question come in about that. You can go to wealthbuilders.net and contact us. And then you can also reply to the email if you would say, hey, I'd like to set up a phone consultation, whether you're a client or just someone that just found us for that. So, well, let's jump into some questions here. We've got about 12 minutes and then we'll wrap up and kind of see. I appreciate everyone being here. Again, let's see. Yeah, I do. I agree, Stacy. I think a Republican White House is better for the economy, whether that's Trump or DeSantis. I think I would agree. I think the policies now are so anti-business that it's painful, for sure. Would agree with you there. All right. Yeah, I mean, a couple questions in here about banks. Certainly on that. We have yeah, I'll put it this way: the big banks you really want to avoid. So if you're with Bank of America, Wells Fargo, Citi, J.P. Morgan Chase, they are at the upper echelon of liberal agenda, woke culture, whatever you want to call it, sex trafficking, you name it. They are right up there. And so I would highly encourage you to work with a local or regional bank or credit union. If you if that money's more for investment purposes or cash management, we could certainly help you at Wealth Builders Investments. But I'd really applaud you if you look for another option there. Um, Inflation, right? Yeah, so we've got some questions about inflation. Um, Social Security increased with inflation, but that's a key part of Biden's America is inflation is not a big deal. So that's part of the problem. With that, I think inflation's a lot higher than what the government reports because you and I know it costs more to go out to eat, it costs more to repair things. So we got a lot of great questions. So let me kind of scroll through here a little more. Um, Yeah, a couple questions on electric vehicles and energy. Interestingly, the Biden administration has really pushed ExxonMobil and Chevron to go green, to not do as much exploration and development. I actually, I'm pro Earth, but I do think that there's still a high cost for going electric, of how much it costs on that end. So I still think there will be companies, and some of them may be private, and we invest in some of them that are doing the fossil fuels on that. So I think it's still a good place to be. It's not that commodity is not going to go away. It's just going to be harder. Um, it's going to be harder for public companies to do it if they get pressure from a Democratic controlled White House. So, electric vehicles are have a lot of potential, investing in them, but still a lot of volatility there. I like some of these traditional commodities. Personally, they do well in inflationary times. Oh, great. Well, lots of good questions. Gold and silver. Yeah. I like it, whether you're owning it physically and just storing it there locally, or it can be stored through an institution. We do both. I can't say if I would sell it right now. I think it depends on your situation. If you're needing to liquidate that for a specific need, if you didn't have a specific expense, I would probably lean towards not selling it if it were me. Right. But if I said, hey, I'm buying a business or paying for a kid's tuition bill, paying for a wedding, you could sell some now, and I'd probably just buy back if it drops back down for it. So good question on that. I've got a question here about um, old 401k retirement plans. Definitely, if you have former employers you've worked for that have a 401k or 403b, it's a great opportunity to roll those over into a personal IRA. And if you want to reach out to us, we'll be happy to connect with you on how to do that. Again, you can connect with us through wealthbuilders.net. And if you're not already signed up, just respond to our emails. You can invest in gold and silver and real estate through a retirement account. There's some different ways to do that. There's some preferred ways I like to see it done. But you can definitely do that. That's called a self-directed IRA. And so you can certainly roll over an old plan from a company or a ministry into a self-directed IRA, and then you can go buy some ounces of physical gold or silver, or even real estate. You're going to need to have a little bit more in there to be able to do the real estate, and you're going to need an attorney's help on that. Um, yeah. Is there a minimum investment to become a client of WBI? So there's a couple different ways we can help you. We do offer financial planning. So we do just some fixed rate financial planning. Even if you don't have a lot of money to manage, or if you're not sure if you want us to work for you, we do flat rate financial planning. So that's option one. And then option two, as far as the minimum investment, most of the work we do starts at $100,000 for investments. Now, there's a lot of things if you're under that number that we can point you in the right direction, and you can actually go do it yourself, and you'll save yourself some money, and we want you to be investing in yourself to learn how to do it. I would say $100,000 or more, then we can really start to do a little bit more diversified things. But either way, even if you're under that, we've got resources to put you in touch with to make sure you're investing with biblical principles. Good question here. Please define passive income. I have it on another show, but check out the Kingdom Finance Show podcast. But in effect, passive income is anything that's, we call it mailbox money, but anything that's going to pay you without you having to earn it using your time. Okay. That could be a dividend from a stock, interest from a bond, rental income from a piece of property. It could be a royalty from oil and gas, right? So it's just streams of income that the asset itself is working for you. You don't have to punch the clock in to earn that income. So there's 6 main categories. We teach a lot on that. We encourage folks to at least get 1 or 2. I would say for those of you that are clients, we're probably doing 4 to 5 of those strategies for passive income. And so be encouraged. If we're working with you, know that that's what we're doing. Yeah, there. And as far as dividend rates, it all varies. Some of the private investments we do generate passive income that's double digit. And so I think we may have mentioned that at one of the conferences recently. But there are certainly some private investments or direct investments. You have a greater propensity Again, past performance not a guarantee of future results, but you have a greater likelihood to earn higher rates of cash flow. We call it cash on cash returns. So stock dividends, bond dividends, CDs, yeah, we're going to earn, 2, 3, 4, 5, 6, 7% dividends. Those are good. But the private investments we do, which is what I call our secret sauce, those are ones that we can earn, double digit cash flow rates of return on that. Hey, these are great. We've got a few minutes left. I really appreciate everyone being here. I'm going to just make some closing comments and look through it and see if there's any other questions I can answer um, pretty quickly. But again, I think main takeaway, I want you to be encouraged that even with everything going on, that the third great awakening is happening, and money is being shifted from there's a proverb that says the wealth of the wicked is laid up for the righteous, and so that's really our heart at Wealth Builders Investments. And so I think as you start positioning yourself right, so I want to encourage you in closing, um, get with your financial advisor. If we are already working for you, follow up with me and our team on questions. But just know these are I'm pretty much laid out a lot of my playbook here on how we view it and how we're implementing it. Now everyone's different. If we have 100 people on this call, some of you may be more conservative, some of you may be more aggressive as far as investments. Some of you may have a shorter time horizon, some of you may have a longer time horizon. But again, our goal is to stay diversified, look for good opportunities, and just don't assume that what Wall Street says is the best way to go about investing. If you don't already have our Pro Values Index, you can go to wealthbuilders.net/invest. And I believe we still have that Pro Values Index on there. So you can go to wealthbuilders.net/invest. And we have the top 30 companies that we promote investing and spending with, and the top 30 that we boycott on that. So, hey, thanks so much. I'm going to wrap up here just to be respectful of everyone's time. Again, thank you to each of you who are current clients. I hope this was helpful to get an understanding of how we view the markets and how we're managing your resources and helping you steward. And for those of you new, thanks so much for being here. And again, Kingdom Finance Show, track us there weekly. And then this economic webinar every month. If you're getting the emails for this, then you will continue to get invited. Please pass it along to friends and family that might have an interest in that. And until next time, we wish you the best. Be blessed, stay healthy, and feel free to reach out to us through wealthbuilders.net. And thanks for being here on the May edition of the Economic Update. Take care. We'll see you next time.